Of Wealth Quarterback LLC, a registered investment advisory firm located in New Jersey. Registration is not an endorsement of the firm or its representatives by securities regulators, nor is it an indication that the advisor has attained a particular level of skill or ability. Investment advisory services may only be provided to clients in jurisdictions in which the firm and its representatives are appropriately registered or exempt from registration. You should not assume that any discussion or information contained in this broadcast serves as the receipt of or as a substitute for personalized investment advice from the advisor. Different types of investments involve varying degrees of risk, and there can be no assurance that the future performance of any specific investment strategy, or product, or any non-investment related content made reference to directly or indirectly in this broadcast will be profitable, equal any corresponding indicated historical performance level or levels, be suitable for your portfolio or individual situation, or prove successful. Past performance is not indicative of future results. Investment advisory services offered through Wealth Quarterback LLC. Tired of losing money in the stock market roller coaster? Frustrated with the government taxing you into oblivion? Worried about inflation? How do you prepare for so many financial uncertainties? Welcome to the show that will help you develop your game plan. The Financial Quarterback with Josh Jalinski. Josh is a noted financial advisor and president of the Jalinski Advisory Group, and he's here to answer your questions. Call into the show at 800-321-0710. 800-321-0710. Now, let's kick off your financial future. Here's Josh Jalinski.
Good morning, everybody. We are live on YouTube, Clubhouse, and New York 710 WOR AM, the voice of New York. So, for those of you who don't know Dr. Hunt, he needs very little introduction because he's one of our favorite guests on the Financial Quarterback broadcast. But Dr. Hunt, what got you into economics?
Well, when I went to college, I wanted to be a doctor, and I in my freshman and sophomore year, I had taken all of the pre-med courses, but in the spring of my sophomore year, I took the first course in economics, and I just fell in love with it. And that was 1962. And by January of 69, I had 3 degrees in economics, including the PhD. And I went into the Federal Reserve, and that was 54 years ago. So I've loved it the whole time.
Wow. So let's talk about your latest Hoisington letter. Folks can go to Hoisington.com to check out, I believe, your latest economic overview. In it, you dropped quite a bombshell. What was that bombshell?
Well, basically that we relearned some very costly lessons. The Federal Reserve was set up to be lender of last resort, not spender of last resort. And the writers of the Federal Reserve Acts were very correct in that decision, because they knew that if the Federal Reserve's liabilities were used to fund demand of the government, that this was the basic definition of inflation. You would have an increase in demand, but you would not have a commensurate increase in supply, which is the very definition of inflation. And as a result of that, pandemic response, it was coordinated with the federal government. We had a 2-year record increase in money, and it's resulted in the most severe cost of living crisis in 42 years. And when you think about that, that's a pretty significant statement, because the average age of the country is only about 38 years, which means that the typical household has no idea what has hit them. Another problem is that the Federal Reserve was designed to be independent of fiscal policy. But in the pandemic response, it was coordinated. Now, this is not the first time that it happened. It happened in 1971. Richard Nixon was president. Economy was struggling. Inflation was too high, it was not coming down, but it was stagnant. There was a cost of living crisis then. President Nixon closed the gold window, which led to a significant depreciation in the dollar. Arthur Burns, who was chairman of the Fed, I was in the Fed at the time, accelerated monetary growth, totally compromised the Fed by agreeing to serve as chairman of the interest rate and control component of the wage and price controls. For a time, the price controls worked in the face of accelerating money growth, but the situation blew up. And when the inflation reared its head very dramatically, the Fed was alone. The fiscal partners were no longer present. And so the Fed had to clean up the entire mess. And that's the same situation we have today.
But here they clean up the mess. I mean,
well, they have to bring down the inflation rate because inflation is so devastating. Price change affects us all. Employment change affects the few. Warren Buffett has a great statement. He says that inflation swindles almost everyone. And I would amend that to say that inflation swindles almost everyone, but those of modest and moderate means are swindled the most. And so in the last 12 months, about 120 million full-time, hourly, and salaried workers have experienced about a 3.5% permanent loss in income. It will never be made up. And we have 72 million retirees. 60 million of them are in pretty bad shape. Retirees always, as a general group, trail those that are working. And so approximately 180 million of us have been absolutely devastated. Now, there are a lot of different people that survey consumer attitudes, but the best is the University of Michigan, because they give the greater weight to inflation, which is the proper thing to do. And the University of Michigan index in June and July has been the two lowest months since 1953 when the index was constructed, which is an indication of the severe pain that our households are under. It's very, very distressing. And in order to make ends meet, households are being forced to go deeper into debt. They're drawing down their saving rate. The saving rate is the lowest since the great financial crisis. In the second quarter, we saw a $312 billion increase in household debt. It was very heavy, record consumer installment debt. And when real income is declining and consumers are leveraging up their balance sheet to pay for the cost of food, fuel, and other necessities, it keeps the economy afloat, but it's not sustainable. And the banks have already made an important signal that they are aware that this combination of increased leverage and the cost of living problems that so many are facing is resulting in a deterioration of the household balance sheet. And just in this last week, the Fed tightened the lending standards to both households and business, which is an indication that the inflation is undermining the economy's ability to grow. And that, combined with the monetary restraint, tells us that we are in a pre-recessionary situation heading for a recession later in the year.
So that's very pleasant news. So what do we, you at one time said we would have a period of disinflation, deflation. When do you see that coming? Or have you changed?
Well, no, I haven't changed the view because it was interrupted by this. We had 2 years of a 20% increase in liquidity. Now, the Nobel laureate Milton Friedman, who was the country's greatest monetary scholar, made the point that if you look at the degree to which liquidity accelerates, this determines the amount of instability that the Federal Reserve causes in the overall economy. So in 2019, liquidity was growing at about a 3% annual rate, went up to 20% in average for 2020 and 2021. That was the fastest acceleration in U.S. economic history. And now, in the last 30 weeks, liquidity is basically unchanged. So you had a huge acceleration, now a huge deceleration. If I could put it in a more in the vernacular, what Fed policy has historically done is that they boom booms and slumps. Friedman also showed that the best Federal Reserve policy is to really contain liquidity growth in a range of 4 to 6%. You allow for technological change, productivity, demographic factors. You look at the production function, and you allow for a 2% inflation rate. Now, in Friedman's day, that range was 4 to 6%. The production function today is much weaker, so the range would only be 3 to 5%. So that's what the economy basically needs to have stable, non-inflationary growth. And for 2 years, liquidity growth was 4 times faster than Friedman's upper bound. And that's the source of the inflationary problem. Now, in 2019, money growth was coming down and it's accelerated. It was struggling because of a massive debt overhang. That debt overhang has continued to get worse because of the combined monetary and fiscal policy operation. And so the debt problems are still with us. And the Fed has basically 2 choices. They have to contain the inflation, because if they don't, we will not be able to achieve stable rise in the standard of living. Many people are in great distress now. But what they're going to find out is that when inflation is contained, if they in fact do the job, that's an open question, then we will be back suffering from the debt overhang. Let me just give you a couple of numbers from the second quarter. So our nominal GDP increased about 450 billion. I already mentioned that household debt went up 312 billion. Government debt in the second quarter went up 250 billion. So that's 300 billion and 250. That's 550 billion, 100 billion more than GDP. The corporate and other debt went up another $100 billion, which means that we became far more indebted in the second quarter. The productivity of debt is falling. And that is exactly why we are seeing declines in all of our high multiplier sectors. The household durables is turning down. Housing is turning down. Capital spending is turning down. And our exports of the big ticket goods are also faltering. And the consumer is still buying basic services. The National Bureau of Economic Research, who's given the job of dating recessions, keys off of 4 different indicators: payroll, employment, production, real income, and business sales. The employment is still rising, but it's the only one of the 4 components that's doing so. Real income is dropping. Business sales in real terms and industrial production are dropping. So 3 of the 4 key coincident indicators have turned down. We've had 2 consecutive quarterly declines in GDP. Worldwide, the standard for a recession is whether there's 2 or more declines in GDP. We already have that. That's not our standard. We rely on the National Bureau of Economic Research Cycle Dating Committee. In the face of this slowdown in demand, We're seeing a very rapid accumulation of inventories, which is going to be problematic as the year unfolds. Another difficulty is that the U.S. dollar on a trend basis is up about 35% from where it was 10 years ago. This is costing us export capabilities, which we're seeing in the big tickets. It also destabilizes the world because the rest of the world has a great deal of dollar-denominated debt. It also raises their cost of living because many of the commodities that they buy are priced in dollars. Europe is in recession. Japan is in recession. The Chinese government this week said, and the first time that I've ever known them to do so, that they would not hit their growth target. And moreover, they said that they would not penalize those that did not meet their targets, which is an indication that China is struggling very badly. And so the labor market, the payroll jobs holds up. But if we look beyond that, the rest of the economy is showing significant weakness. And in actuality, the labor markets may not be nearly as clearly improving as they appear, because we have two employment surveys. One is a household, which is less known. But in the last 4 months, there's been a huge divergence. One of the most unusual that I've seen. These divergences have occurred, but this is very large. The payroll
Let's talk
jobs.
more about that divergence when we return with Dr. Hunt. As we take our first break, folks, we'll go to your audience questions at 800-321-0710, 800-321-0710. If you have a question for Dr. Hunt, we'll ask him next, what is this divergence that he speaks of? And where does he think interest rates need to go to cool the current inflation? Up next, this is Josh Jalinski, the financial quarterback. Don't touch that dial.
Tune in to the financial quarterback Josh Jalinski this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Jalinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the financial quarterback and count on Josh Jalinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jalinski.org. That's JALINSKI.org. Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the financial quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to the financial quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check.
Okay, we're back with Dr. Lacy Hunt of Hoisington.com, where you can read his latest second quarter outlook. So we talked about this divergence. What is the divergence, Dr. Hunt?
Well, in the last 4 months, the payroll jobs have increased 1,650,000, 500 odd, which came in the month of July, which was much more than was expected. However, we have an alternative survey called the household survey. The payroll comes from about 170,000 of our largest firms. It's not a complete count. Because we have 670,000 firms. But it is a favorite of a lot of people, including many at the Federal Reserve. But there is an alternative survey. It's called Household. it's derived from a very, very large random sample. In my opinion, the random sample has a very small error factor. And in the last 4 months, the household survey has actually declined about 170,000. In other words, for the 4 months, there's a divergence of 1,850,000. And both of these two series cannot be right. And I suspect that the household is the more reliable indicator, just as it was when there was a divergence going into the recession in 2000 and also into the great financial crisis in 2008. Time will tell, but the labor markets may not be nearly as robust as they appear to many.
500,000 people be just, do they factor in seasonal jobs into that number?
They do. Both of these numbers are seasonally adjusted, but it's very difficult to do. Another problem that the payroll survey has is that it does not survey the small firms, and so they have to use very sophisticated estimation procedures. It's something called the birth-death model. Some people call it the plug factor. It was very large in the month of July. Another thing that is of significant note is that the weekly unemployment claims, which survey about 670,000 firms, have risen about 40% from their low point around the first week of April. And we've seen a deterioration in hiring plans and also in the employment levels as measured by a number of diffusion indexes in the manufacturing and service sector. So the job gain in July is very large, but it cannot and should not be viewed in isolation.
So it's not a year change. So what I was getting at was if they took July and July of 21 or June of 21 and June of 2020, well, due to COVID, a lot of these seasonally adjusting would be out of whack because the seasonal adjustments, really weren't. I mean, I live in a shore town in New Jersey, and they couldn't get anybody the last 2 years, and maybe they're just starting to get people, bring them in from other countries, things like that. That's what I didn't know if it factored in that at all.
No, you described it perfectly, Josh. So every year, the Federal Reserve takes the raw changes before seasonal. The Bureau of Labor Statistics looks at these raw changes, and then they have a seasonal adjustment procedure. And what they did in compiling this year's seasonals is that they did not make any assumptions for the movement from month to month in 2020 and 2021 when the COVID was increasing and decreasing, we were closing things down, reopening. In other words, they treated all of the monthly changes for the last 2 years, which are dominant in setting these seasonal factors, as being a seasonal movement when we know they weren't. And so it's quite possible that the seasonal factors are just way off the mark because of the impact of COVID. And that's one of the reasons why the household survey, where the seasonals are not appreciably different, may be more telling indication of the true status of the economy.
Well, next we're going to go to Sam, who has a question on Clubhouse, the social audio app. Go ahead, Sam.
Yeah, thank you. You mentioned that the household savings rate dropped to its lowest level in June and July. I was reading an article on CNBC from, I guess about 2 years ago, May 2020, stating that the U.S. household savings rate had hit some of the record highs, I guess, for some time. Can you talk about, that deceleration, that rate of change, and what that does to the economy?
Well, when the 3 rounds of Federal Reserve financed payments went out, the saving rate surged very dramatically. And the article was correct for the time. And we went up, the household saving rate went up into the teens. But keep in mind that those checks were temporary. And we in economics make a big distinction between transitory income and permanent income. What is happening now is the surge in prices is so much greater than wages, and that it is resulting in a loss of permanent income. Now, we have the household saving numbers since 1929. During that time period, the average was 9.1%. And in the month of June, it is 5.1. So we went above it, but it was a transitory gain. And now the saving rate is quite low. The saving rate can move up or down depending upon whether people are putting funds away. But if you take on more debt, that is counted as a reduction in saving. And what has caused this very precipitous decline in the household saving rate in the last 7 or 8 months is this very rapid leveraging of the household sector. The consumers have made record use of their credit cards, and I think the reason is quite clear. Their real income is falling. A lot of the inflationary pressures are in these basic necessities, what we in economics call price inelastic goods. They are what we in the must-buy category. There are no good substitutes for fuel as a group, and rent. You have to pay those, and that's where a lot of the inflation is. And so in this environment, to make ends meet, the households are taking on a lot more debt, and that keeps the economy afloat temporarily, but it is typically a precursor of recession.
All that makes me think about is 07. Are we in 07 before 08? And really 2022's little rip in the market that we've had will really become much worse into next year? I know you're not a stock market analyst.
I think that is a good case. I think you can make a good case. And I think we're in a pre-recessionary environment. For example, we've had 6 declines in the volume of retail sales in the last 8 months. The freight numbers, both trucking and rail, are showing a slight decline. There's an old adage that they don't ship what they don't sell. The vehicle sales, new home sales, existing home sales, they're all 15 to 30% below where they were prior to the pandemic in 2019. And the economy is losing demand. And another problem that's happening here, it may not be as visible. When output is stagnant, and remember, keep in mind, we had a slight decline in output in the first half of the year, and firms continue to hire. If that is the case, then productivity is falling. In the first quarter, there was a 7% decline in productivity, and the broad corporate profits numbers compiled by the Bureau of Economic Analysis using the income tax data showed a significant decline in corporate profits. And there will be another large decline in corporate profits in the second quarter because of this erosion of productivity. And so even though the payroll employment has not reflected it, we're seeing a steady diet of announcements by an increasing number of firms that they are suspending hiring operations, some cases layoffs, to try to control costs. And that process, in my view, has just started, but it's going to get worse. So yes, Josh, this is very similar to 2008. very similar to 1999, early 2000. It's similar to several of the recessions since the end of World War II.
Fantastic. Dr. Hunt will join us after this short break, and I'll ask him to reveal where he thinks interest rates need to go to combat the current inflation story. Also, what to make of JP Morgan's latest report that they see chance of recession very high and some problems on the horizon where they're suspending buybacks, warning of global economic, really something not seen since 2008. When we return, this is Josh Jalinski, the financial quarterback. Don't touch that dial.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the Financial Quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to the Financial Quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check.
We're back. This is Josh Jalinski, the financial quarterback. Got a bunch of people in here, Dr. Hunt from Clubhouse. They love you. We're all your fans. So we're going to go to John. John has a question on CPI lagging. Go ahead, John.
Josh, it might be a little too loud with the kids in the background, so if it does, feel free to take my question. But Dr. Hunt, thanks for joining us again. Really appreciate all your work. I'm just playing out the timeline of this, and I know you expect us to be entering a recession if we're not in a recession, but typically headline inflation or CPI typically lags, right? And it takes a while for that to come down. And so do you expect us to be entering a stagflationary period, entering a recession and having kind of like a lag indicator of CPI still running really hot before the Fed or others can get CPI under control and closer to target 2, 3, 4%?
Well, it's going to take a determined effort. I like to sort of do it in terms of liquidity growth. I particularly key off deposit growth. So we had 2 years in which the growth was 20%. The optimum range, according to Friedman, was 3 to 5. So it was very rapid. We have slowed it down. There's been no increase so far for 7 months. But if you look at the liquidity growth since the start of 2020, the average rate of increase is still 15%. So it's still 3 times normal. And I have to be very candid with you. Professor Friedman did great work. He looked at the situations historically, but the current one is very unique because we never had 2 years of exceptionally rapid growth. There's this mountain of liquidity there, and to bring the say the 3-year growth rate in liquidity into the Friedman range of 3 to 5% would require liquidity growth to remain flat for the balance of this year and next year. And that's a tall order for the Fed. So if they do not achieve that and they give up the fight, then and reverse themselves, then what might happen is that this pool of liquidity that they've created would be re-energized. In that case, the economy would stabilize, but inflation would come back. But we can't prosper during inflation. there's a view misheld, but incorrectly held by many people, that we can inflate our way out of problems. We cannot do that. The vast majority of our people suffer under inflation, just as they have this year. And so the Federal Reserve has to contain the inflation to have stable growth. But the debt overhang, which was controlling the situation for most of the time from the late 90s to 2019, is still there. In fact, it's worsened. And debt, extreme levels of debt are deflationary or disinflationary. So the Fed is in between a rock and a hard place. There is very little pathway, in my opinion, for the Fed to engineer a soft landing. In 1966, we were in the middle of the Vietnam War inflation. President Johnson was also trying to fund the Great Society programs. Inflation was out of control. Martin moved to try to do something about it. Was beginning to have some success, but then President Johnson put pressure on him to reverse. So we did have a credit crunch in 1966, but there was no recession in 67. Unfortunately, and that we achieved this, that's one of the soft landings, one of the very few. But the inflation problems then reemerged, and William Martin then had to tighten monetary conditions even more significantly. In 1968 and 69, we had a recession there. It was a mild recession, didn't take care of the problem. That led to the Nixon administration's erroneous response. Burns then instituted monetary restraint in 73 and 74, caused a major recession, but the inflation was not really dented because it had built up such a steam starting in the early part of the Vietnam War. And so the Fed has a difficult job. They have to contain the inflation. If they operate under the assumption that they don't, then the economy will struggle along in a very disjointed way, and the majority of our people will fall between the cracks, as they are falling between the cracks now.
Wow, great answer, Dr. Hunt. Next, we're going to go to Joe. Go ahead, Joe.
Yes. Good morning, Dr. Hunt. I have two quick questions, and hopefully you can answer them both. I'm going to give you them both. First off, I'm curious what you thought, or if you reviewed the recent piece by Zoltan Pozsar, where he quotes, and it's an interesting comment. I've heard this anecdotally from others, and I want to know your thoughts on it, where he says, it's time to think more about the risk of inflation staying higher for longer due to economic warfare, and less about inflation being driven by messy reopening process and fiscal stimulus. And whether you concur with that, it seems to corroborate some of the data we got. And Chairman Powell has talked about how last summer we saw some metrics of inflation trickling down, and really the main impulse behind these current numbers seem to coincide with the war in Ukraine. So I'm interested in what you think about that. And I also wanted to get your comments on what you wrote in the most recent second quarter letter. You stated in the letter at the end, in the conclusion, if the Fed stays within the scope of the Federal Reserve Act, they will have difficulty in containing the recession and fostering a recovery. I'm wondering if there's something specific that gives you cause for thinking that the Fed, to get us out of this recession, anything specific that points you to them expanding or exceeding the scope of the Federal Reserve Act? Thank you.
That's great. Two great questions. The Federal Reserve was set up to be lender of last resort, not spender of last resort. When they become spender of last resort, you increase demand, but there's no commensurate increase in supply. And that's the very definition of inflation. So if the economy were to start going down, and the Federal Reserve would once again revert to the spender of last resort, we would have the same result that we got from the nearly unprecedented increase in liquidity in 20 and 2021. The Fed cannot go down that road. It would provide some stability to the economy, but then the inflation would roar back. And in this situation, it is complicated by the fact that there is still this huge pool of liquidity that's floating about. And in my opinion, the Fed may not understand it, but one of the misconceptions of a lot in the Fed and others is that the misery index is a valid concept. Now, the misery index gives equal weight to inflation and employment. And that's not correct. The more important variable is inflation. Inflation affects us all. And the higher the inflation, the greater the negative impact on the majority of our people. So if the Federal Reserve does not tend to the inflationary problem, then you would have that, the risk is that you would go into a replay of that long string of events from the mid to early 1960s all the way to the early 1980s, in which the Federal Reserve tried intermittently, but never successfully, to contain the inflation, and the inflation kept getting out of control, which did more and more damage, and which, of course, culminated in the cost of living crisis of 1980, to which the country, and particularly the Federal Reserve, led by Paul Volcker, dealt with. But inflation has to be the priority, and if the Fed doesn't understand that. Another difficulty is that when the Fed unveiled the pandemic response, they said that they would honor the lender of last resort, that they would not be spender, but they did violate it. And so the fact that they've done it once gives concern that they may do it again. Another problem is that the Fed doesn't seem to have a view as to what determines inflation. They first of all called it transitory inflation, then they called it pandemic inflation, then they called it Ukraine war inflation, now they call it demand inflation. But inflation is largely a monetary phenomenon, and they're not willing to admit that. In fact, they have said that they've had to unlearn that money is important. Well, that's a very sad event, because we have a chronic example of what happens when they ignore what happens to money. And I think that is a highly disconcerting situation. And so the Fed needs the proper strategic view. My feeling is that our greatest Federal Reserve chairman was Paul Volcker. It happens that he and I knew each other for a long time, a friend of mine, but he did the job. Now, Powell said that he's willing to be Volcker, but he doesn't have Volcker's strategic view. And some of you might like to reread it or read it for the first time, Paul Volcker's autobiography, in which Volcker talks about his meetings with Friedman and how Friedman was able to demonstrate to his satisfaction the important role of money in causing inflation. And if the Federal Reserve chooses to ignore that, then that's their problem. But I will tell you something, for those of us on the outside, we cannot ignore what's happening to money and liquidity, because that is a very powerful component. And especially if the Federal Reserve veers away from the lender of last resort to the spender of last resort, which is the pattern that we saw over the last 2 years. That was a fantastic question.
Joe, as always, the last time you were on, he was the questioner of the day. Definitely the questioner of the day today. So good job, Joe. Up next, I'm going to ask Dr. Hunt where he thinks interest rates will go. We'll go to some more audience questions. Also, March of 2020 indicated that the Fed doesn't play by the rules anymore. So are all these old metrics and things that we look at, although, economics is kind of like physics, there are laws of economics, there are laws of physics that will eventually take over. Will the Fed just, if we learned anything by March of 2020, it's that they don't play by the rules, that this lender is turning into spender, and that could cause massive distortions, MMT, all that stuff. So I'll ask him about that when we return. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
Tune in to the financial quarterback Josh Jalinski this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Jalinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the financial quarterback and count on Josh Jalinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jalinski.org. That's JALINSKI.org. Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the financial quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to the financial quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check.
Okay, Joe, do you have a follow-up to your question from before we go to mine? Joe? Okay. So, Dr. Hunt, where do you think interest rates will go? Question number one.
I think the short-term rate, the federal funds rate, the policy rate is going to continue moving higher. I think it'll go to 3.5%. I'm in agreement with the market. My view is that the long Treasury rates are in a topping pattern. We may have already seen the peak. I think that the controlling element is that that the monetary restraint is working. We're headed toward a recession. Several indicators of that. The index of leading economic indicators has declined for 5 consecutive months, peaked in February. It leads the economy by about 10 months. So by the end of the year, the LEI would be suggesting that. I think it's interesting that in the last 6 months, the leading index has fallen at a 3% annual rate. In other words, it's already gone into negative territory, which is an indication that things may be moving faster to the downside. Another confirmation of the liquidity slowdown that's underway is that we're seeing an growing inversion of the yield curve. I like to measure it between looking at the spread between the 2-year Treasury and the 10-year. The curve is now inverted with the 10-year on top of the 2-year by the largest number of basis points since 2000. When that happens, it tends to put pressure on the banks, and it reinforces the monetary restraint. So the recession is unfolding. So the long-term rates, although they will be volatile, may be in the topping pattern, even though the Federal Reserve will continue to push the short rates higher.
Next up, we're going to go to Tina. Go ahead.
Hi, Dr. Hunt. Thank you very much for being here this morning. We do all love to hear your commentary. You do great work. Do you have a sense of where long rates can go in a recession? 10s, 30s?
I really don't. I'm looking for a set of conditions. I'm quite confident that it's appropriate to have a long duration, which Hoisington management does. But as we get into the downturn later in the year, it's going to be very important to see what type of approach the Federal Reserve takes. If they operate within the confines of the law, then I think monetary policy will be very ineffectual. I think monetary policy is asymmetric. I think when the Fed wishes to tighten monetary conditions, that still works. But when you're very highly over indebted and the marginal productivity of debt is falling, that tends to reduce the deposit multiplier, tends to reduce the velocity of money, and that makes monetary policy largely ineffectual. The old-fashioned term, which is more appropriate today because of the extreme over-indebtedness of the economy, it truly is like pushing on a string. And so the inability of traditional monetary stimulus to work raises the risk that the Federal Reserve may chance repeating the pandemic response, which worked but only transitorily before making all of us worse off.
Great. And that goes to my question. What about these, there really are no more rules anymore. These people don't follow Friedman. They don't follow Volcker. They kind of do whatever the political winds are telling them to do. Do you talk, number one, do you talk to people at the Fed? Hey, if I was the president, you would be my Fed chairman. But what do we do it seems like they just throw out the rules. Are we going to have, Jerome the Hawk or Jay the Dove, or, it just every day, they're just putting their finger to the wind and they couch it a little differently. So it almost is like the old rules, they're throwing out the window.
Now there's a presumption of power that they shouldn't have. The Federal Reserve was set up correctly by the founders, the writers of the Federal Reserve Act. Keep the Federal Reserve as lender, keep the Federal Reserve independent of fiscal policy. You don't want the Federal Reserve operating in conjunction with fiscal policy. The two instances we did it blew up in our face, and then that leaves the Fed to get the job done. Another problem is that the Fed is to be credited for the fact that it has achieved diversity in a lot of ways, racially, ethnically, religiously, gender diversification. But the real problem for me is that there's no intellectual diversity. The Federal Reserve is dominated by the neo-Keynesian school of economics. And I think that it's badly flawed. Their models are static. They give overweight to this equal importance of inflation and employment. They give excessive weight to the Phillips curve, the so-called notion that there's a trade-off between employment and the inflation rate. Their the models are static. They're not dynamic. They don't take into account the swings in monetary growth. And there's really no alternative view. And that's sad that the Federal Reserve has just become so monolithic in its thinking. And I don't think that we're well served by that. And it concerns me. But there's nothing I can do about it. It's been a long time since I was in the Federal Reserve. I left in 1973 after serving during the reign of Martin briefly and then Burns. But one of the problems, if you're Federal Reserve and you leave and you criticize the Fed, you lose all your old friends.
So did you lose all your old friends, Dr. Hunt?
Yeah, some of them have just gone on to their reward too.
Man.
It's when you're 80 and your 54th year of your career, I'm not aware of anyone that was a PhD economist in the Martin era that's still professionally active. There may be someone, I'm not who. There's several from the Burns era, but it's as time goes along, things thin out.
I think they need to bring you back because I think this market.
As I know, he's doing well. I'm sure
this whole market thing is going down to 73 to 74. I don't know what that was. It was probably the, the station guy. 73 to 74. This reminds me a lot of that first leg down in the market at 73, that we have another 74. Do you see a historical parallel? I know you mentioned late 60s. Do you think we're more in 67 or 73?
I would say that we were more in 73, 74. I think that that the job is not done. The Federal Reserve's process of containing inflation is got a ways to go. They're going to have to be willing to persevere, but in so persevering, the spreading economic weakness is going to become more intense, and we'll see what they choose to do. But if they choose inflation, inflation will only be a temporary benefit. It will be a millstone for a long time to come.
Well, that was a really exciting hour with Dr. Lacy Hunt. We got hundreds of people here on a Saturday morning. Maybe we can pull your arm to stay with us for a little bit more. We'll see. So stay tuned. This is Josh Jalinski, the financial quarterback. Go to Hoisington.com. Download his latest second quarter PDF. It's for free. It's the best free newsletter based on economics on the whole of the internet, in my opinion. Folks, give us a call now, 888-988-JOSH for your free bear market survival guide or your 7 ways to save taxes review. 888-988-JOSH, 888-988-JOSH.
WOR
Can
and
somebody ask him if he can
WAXQ
stay?
New York, an iHeart radio station. Available everywhere on our free
You guys want
iHeart
him to
radio
stay a
app.
little
Number
longer
1 for
if I can
music,
get him?
radio, and podcasts.
Yeah,
New York mornings
stay
aren't
another
easy.
10 minutes.
Glenn and Michael make them more entertaining and informative.
That helps.
What?
Weekday 6 till 10 on the...
He said he can stay. I don't want to monopolize him.
No, I can go another 12 minutes, let's say.
Okay,
10,
another 12 minutes. Good. Wonderful. Yeah, you have a lot of fans here on Clubhouse.
Okay, well,
And
we'll try to answer as many questions as possible.
We had 300 plus people in the room, plus, thousands on New York radio. So Dr. Hunt, these people just sit around, and sometimes we do whole rooms. They're like chat rooms, I guess. I don't know if you're familiar with Clubhouse. And we sometimes,
not really, Josh.
we sometimes just listen to you speak for an hour on a YouTube or something like that. So whenever you get on here, you have a cult following.
Well, I'm pleased to hear that.
And
I'm
I
not
bet
very technologically advanced, Josh.
and surprisingly, it's in the Bitcoin community too. You have a big following
scheduled court hearing
among Bitcoiners.
He was found
Now,
in his
the radio
Briarwood
show
home
is going to go
Friday
back
morning.
in and forth,
The
and then
51-year-old
I'll
pled not guilty
go
in
back
June
to you in a
to
couple
murder, weapons possession,
minutes.
racing, and other charges. Police say Hirsch had multiple prior
Clubhouse
disagreements with the
people,
Great
for those
Wall
of you who don't know, on
restaurant where the
YouTube and
victim
Clubhouse,
worked,
I do a radio show on one of the biggest
including complaining he didn't
stations
get enough duck
in the
sauce with an
country,
order
so
in
there are
November. He was
station
given more of the
breaks.
sweet and sour
There
condiment,
are,
but demanded a refund and called cops when he didn't get one, according to prosecutors. I'm Lisa G. WOR News.
If
The White House press secretary is
Josh, can you hear me?
insisting the U.S. is
Go ahead.
not in a recession.
If there aren't other questioners, I'll ask a question.
Sure.
But if there are other questioners, you can take their questions.
Yeah, we got Cheng, and then I'll go to you.
Karine Jean-Pierre told reporters the economy is in an ongoing period of transition after the height
Someone
of the
says,
pandemic.
do you follow the Saturn-Uranus cycle?
No, I don't. I don't even know what that is.
We are apparently at the same square as the Great Depression, he says.
Okay, I didn't know that.
The reality TV star and Saturday Night Live comedian are reportedly breaking up because of their busy schedules. In sports, NL East
Saturday Night Live?
showdown. Mets fell to the Braves 9-6. Taijuan Walker charged with 8 runs and only recorded 3 outs. Mets still 3.5 up now on the Braves.
I don't know.
Also, the Yankees fall to the Cardinals in St. Louis 4-3.
Here's your WOR Weather Channel forecast. Afternoon heating should trigger some scattered thunderstorms on this Saturday as the high climbs to 87.
Great. So, folks, ping in your friends. We're going to be back on in 2 minutes with Dr. Hunt after the
Sunday with the high
news.
reaching 87 and then clearing at hotter for Monday as the high tops out in the low 90s. I'm meteorologist Jeff Marr.
Next news at 11. Start your day with Len Berman and Michael Rito in the morning, 6 till 10 weekdays. I'm Paul DeCastro on 710 WOR. an NBC News radio station.
Tired of losing money in the stock market roller coaster? Frustrated with the government taxing you into oblivion? Worried about inflation? How do you prepare for so many financial uncertainties? Welcome to the show that will help you develop your game plan. The Financial Quarterback with Josh Jalinski. Josh is a noted financial advisor and president of the Jalinski Advisory Group, and he's here to answer your questions. Call into the show at 800-321-0710. 800-321-0710. Now, let's kick off your financial future. Here's Josh Jalinski.
Okay, we're back with Dr. Hunt, and Cheng has a question. He's been waiting patiently. Go ahead, Cheng.
Hi. Thank you very much for bringing on board. My basis of the question is this. Right now, what we see is that the inverted yield continues deepen, and would that really cause a overall liquidity issue? Because what we see is that the in the commercial space, the landlord are increasing the rent, which therefore cause further increases in the CPI, since rent is part of the huge calculation in the CPI. But at a certain point, when the interest rate is going so high, nobody's able to afford the rent. Economy goes in crapper. People lose their job. People cannot, extend their balloon payment through another loan because there is no justifiable income to justify those cap rates. So, where do you see, as we see this incredibly insane deepening of the inverted yield?
Well, boy, that was well said, Cheng. You know your economics. In my view, the yield curve, or the degree to which it's positive or negative, being negative now or inverted, is largely a confirmation that monetary restraint is biting. We do this in two ways. There's a causal effect, and there's also a psychological effect. When the yield curve becomes inverted, the banks are not able to borrow short and then lend out the curve and make a profit. And that becomes difficult for them at a time when the business sector income and household income is declining, because the banks know that will lead to increasing delinquencies. But the inverted yield curve is also a confirmation that liquidity growth is dropping. Now, this situation that you described with rent is largely of the Fed's making. Keep in mind that they basically were commercial banker to the mortgage industry, and they funded a huge bubble in home prices. Now, that was fine when it was going up, but the bubble in prices has served to price many households out of buying a home, particularly modest and moderate income families. And so as they're being formed, they're then forced to rent. So the home prices go up, and then people cannot afford homes, so they then try to rent, and that sends the rent price higher. And the Federal Reserve is being bitten in the tail by its own actions. And so I hope we've learned a lesson that when the Federal Reserve should not engage in providing credit to any sector. That's really not the Federal Reserve's job. The Federal Reserve should determine the aggregate level of liquidity availability, and let the allocation of credit accrue and be determined by the private sector, not the Federal Reserve. And so we have this intolerable situation where, if you look at home prices versus income on a normalized basis, the home prices are more than 40% above income. And that's an intolerable imbalance, all that the Federal Reserve's making. And it's going to take a long while to work it out.
Wow, Dr. Hunt, that's great. We're going to go to Tina Tina stands for There Is No Alternative. So go ahead, Tina.
Hello, Dr. Hunt. Nice to talk to you again.
Nice to talk
Jeff
to you.
Jeff Snyder, who's an analyst who looks extensively at many of the same things you're looking at, plus the Eurodollar market, has observed that the premium for instance, the 1 month Treasury bill, currently at 2.16%, versus the reverse repo rate at 2.3%, indicates a collateral shortage in the system. Do you agree with his conclusion? And do you have any thoughts on the implications of the collateral shortage for U.S. Treasuries?
This is not my area of expertise. I will say that Jeff is a first-rate analyst, and I've seen really good work from him over the years. And because of his track record, I think his views need to be considered thoroughly. But that's just not an area where I'm working, and where I've have my own set of skills available. But I think when he makes that argument, it's something you have to respect.
Thank you very much.
Okay, next question. Someone on YouTube would like to know your thoughts on the muni run through the second half of 2022 from YouTube.
Well, I'm not a muni investor, and at Hoisington Management, we confine our investment recommendations to the Treasury market. So that's part of our code of operations, and I just am not knowledgeable enough about it, and so I'd love to give it a shot, but it's not a professional view, and so therefore I have to pass.
Well, let me ask you the professional view on Treasuries. Would you tie up your money with the government for 10 years? Do you like 10-year Treasuries right now?
I've never bought Treasuries to hold for 10 or 20 years or 30. I've bought 10, 20, and 30-year Treasuries, but only for a horizon that I thought that the yields were going to be able to go lower. And when I thought that yields were going higher, I've recommended holding short-term Treasuries. The current environment is very complex. I think it is the most complex that I've ever seen in my career. And my career, I did a lot of study of the situations that existed before I came on the scene. I think the current situation is amazingly complex. But I think the critical factor for the time being is that we're on a path toward recession, and that long duration in the Treasury market can be held pending a Federal Reserve response and the nature of the Federal Reserve's response.
So that would be good for Treasuries, but just with an asterisk that you don't control what the Fed does.
You always have the correct way of saying it, Josh.
So there you go. So we have Gordon, longtime listener, wants your take. Go ahead, Gordon. I'll let you answer.
Yes, Josh. Dr. Hunt, I can't tell you what a pleasure it is to speak to you again.
Well, thank you, Gordon. Nice to speak with you.
Since we've learned, apparently, over the last couple of years, that shutting down the economy and printing money nonstop may not be the road to prosperity. So I was wondering if you thought this at least put a dent in what's called modern monetary theory.
Well, great question. Boy, I'm happy about that question. I think that what we've learned is that modern monetary theory is a complete fraud. When you hear people say that we can inflate our way out of our problems, they don't know what they're talking about, because the vast majority of our people cannot prosper during inflation. In inflationary episodes, prices outstrip wages, which is what's happened in the last year. We have a series called real wage and salary income of all hourly and salaried full-time people. And in the last 12 months, that's down 3.5%. And it's not a base issue because we were declining for 15 months. That's the largest decline since 1980. That's why I'm able to say that this is the worst cost of living crisis in 42 years. The notion that somehow that we can do well in inflation is just a completely fallacious number. They're basically, you have to use monetary policy in the appropriate way. The Federal Reserve Acts were written to achieve that balance. We veered out of that, and now we're paying a very, very heavy price. And the worst thing from my perspective is that the critical working families, the one that this economy is so dependent upon, to get up every day and struggle forward and do the right thing, have taken the biggest brunt of this inflationary surge. And we need to remember this lesson and never forget it. And hopefully that is something good that will come out of this experience. Thank you so much for the question.
Yeah, hopefully this spell of inflation is a lesson. You said the average age of the American is now 38. They've never experienced this pressing inflation. They didn't know that the Fed could harm them by their policy. Now they know that. I mean, they were ignorant of maybe 2000 to 2002, 2007 to 2009. It seems like every one of these major collapses, the Fed has a misstep. Inflation is transitory, maybe that misstep in this kind of bout. What do you think? Can they correct the ship at all? Will they correct the ship?
They have the capability of doing it. It's a matter of will and perseverance and understanding that inflation must be the priority as long as it's this high. They need to get it back to 2%. And we'll see whether they are able to do that or not. One of the things that is very disconcerting is that the Fed uses this line that we're data dependent. Well, that's not what the record shows. I mean, the inflation began moving above their target at the end of 2020. And then it was double their target. Now it's triple their target. And the Federal Reserve did not act. And they delayed. And they said they couldn't begin raising the federal funds rate until they had ended the quantitative easing. Well, there was no rule set in stone that they couldn't do both at the same time. That was something that they made up. And so they may say that they were data dependent. Now, some of the Federal Reserve advocates say that the Federal Reserve didn't act because there was a fear that if the Powell Fed had tightened in 2021 before he was reappointed, that he would not have been reappointed. Well, that reminds me of the great book by John F. Kennedy, Profiles in Courage. The great leaders step forward, regardless of the political consequences or personal consequences, and they have to do the right thing. And the Federal Reserve has to do the right thing, and if they don't, then we're all going to suffer.
That's a great way to end this segment. Dr. Lacy Hunt. Check him out at Hoisington.com. And I want to thank you always for joining us, Dr. Hunt. A lot of fun.
A pleasure. Always great to be with you, Josh.
Great to be with you, too. So we'll be back, folks, after these messages with your thoughts, questions. Call me right now, 800-321-0710. I'm going to talk about how I think MMT will be here to stay. These people are so insane that they actually believe there's not enough government intervention and how they'll just keep doing it. Why? Because that's what they were bred to do in socialist training grounds known as American universities. Up next, this is Josh Jalinski, the financial quarterback. Don't touch that dial.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the Financial Quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to The Financial Quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check. Tune in to The Financial Quarterback Josh Jalinski this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Jalinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to The Financial Quarterback and count on Josh Jalinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jalinski.org. That's JALINSKI.org.
Got a lot to talk about, but I want to hear from you. Give us a call, 800-321-0710. AOC, your favorite niece or nephew, talk to them. They still believe in this MMT crap. Why? I personally think we need to defund higher education. I'm all for education. I have my master's degree, all of these other things. Somebody says, Josh, I hope you use hard candy or lozenges. No, I didn't bring my lozenges today. So there's a question here. If you were to bet on what the Fed will do, raise rates high enough above neutral to kill inflation for good, even at the expense of a deep, protracted recession, or to succumb to political pressure to ease as soon as recession risks rise and leave the risk of inflation coming back, which one would you think the Fed will go with? I believe that question was probably for Dr. Hunt. My stab is I think they'll bow to political pressure. If I was to give an outlook, I think they'll look for anything that will show inflation is cooling as a sign to stop rates. It'll probably bring the market back to maybe even new all-time highs by the end of this year. And then next year, just the bottom will drop out and maybe we'll have SPX 2600. I don't know. If they do what they're supposed to do, maybe we hit SPX 3000 this year, and then maybe we get through this. But I think interest rates need to be like 8 or 9% for them to cool this. You basically need people. I was going to ask him this, I didn't have time. I'm looking at friends of mine that I went to high school with that are just regular, middle-class folks. They are struggling to pay rent of $2,500 a month. Their rent's going from $1,500 to $2,500 this year, or they'll be kicked out of their homes. $1,250 to $1,750, or they'll be kicked out of their homes. How are they going to survive? Many are moving in with relatives, downsizing. What is the untold story? Well, with MMT, it's defund higher education. With the inflation that we're seeing, I don't know if it's going to cool from a rent and housing perspective. Why? If you look at Florida, where a lot of the growth is occurring, just as a microcosm, Florida's a little bit different because 0% state income tax, but that's where I'm seeing a lot of these reports of people being priced out of their rental homes. Who owns those rental homes? Private equity. Now, if you were an investor in multifamily, if you were an investor in residential, they were gobbling up homes that now would sell for $500,000 for $100,000 in 2010, 2011, 2012. They can stay on those homes forever and make a nice, healthy profit for their investors. What I could see developing, this is in 5 years from now, but just like we had big tobacco and big pharma and big, Wall Street, you will soon see the stories of progressive politicians, and I'd probably agree with this, call out big real estate because people will not be able to afford the homes. If you think about how many wealthy people own farmland now, gobbling up farmland and not producing for our crops. People are gobbling up residential real estate, investors. And that's a hidden story of the inflation. I don't know if it's actually real inflation or whatever, but it's the effect of keeping rates artificially low for so long. I'm also of the opinion that where rates are right now does not mean doom for the economy. The question is, if we have 8%, 9% rates, that's when we could see a big sell-off. So give me a call now, 800-321-0710 if you have a question. If you have a question, type it into the chat box. Taylor has an interesting point on how it's turning into monopoly. That's exactly true, Taylor. Basically, you have a bunch of kids like me. I'm not a kid anymore, but we played Monopoly, and that's just what they did. They mortgaged everything to buy more because they could afford it. It's a consequence of low rates forever. It's also untethering money from reality. Making money cheap causes ill-intended consequences. Or was that the consequence all along? You know, these MMT people, they never say our philosophy has failed. They say we've never done enough spending. Just add a zero. And I got news for you. I think we need to opt out of the system. The system that educationally breeds this kind of incestuous thinking on the left and on the right as well. People are not independent thinkers. Okay. Stu on YouTube says this: January 1986, first fixed mortgage, 30-year, 17%, no jokes. No joke, refinanced so often, but paid the same amount. So got paid off in 15 years, but thankfully we accepted that. I think it's going to probably, I don't know, about 17%. I know many analysts say, 8%, 9%. Next up, we're going to go to Cheng. Cheng, do you have a question or comment on that?
Oh, no, just try to continue the conversation as to when is the breaking point, right? We understand that Fed is increasing interest rate, which caused a self-induced inflation due to the rent price increases from the landlord that need to justify the capital costs increases due to the interest rate increase. So as a result, when is the breaking point for America? When will people no longer be able to afford their houses? When is going back home and living with mom and dad be the last resort? Or if there, for some people, there is no mom and dad to go back to, then what?
I think we'll see that play out. Maybe 18 months, maybe 24 months. It's why when people say, real estate always goes up, they've not been through a 73, 74. I remember the late 80s, early 90s, 2007 to 2009. Now, there are people who suggest, and we've had demographers on, that say basically this trend is unstoppable in that there are so few homes to buyers that's just going to keep it propped up. But I think if we open the hood, if we look under the hood, we will see a lot of private equity players. We'll see, all of these people selling real estate on Instagram, on social media, multi-family units. Everybody's now a real estate millionaire. I've never met more real estate millionaires in my life. Similar to 07, but I think this could be much worse. So, and hear me out. In 2005 to 2009, we saw, Jim, my buddy Jim, who's with me. He may have bought a second home with a ninja loan. Ben might have bought a first home with a ninja loan. So no income verification, but they bought a second home. So everybody was buying second homes with really no money down. So the 07 to 09 crisis was fueled by that. Could the 2022 to 2024 crisis be fueled by really wealthy people or by above average wealth, not buying the second home? There is that. Those people might be able to afford that. I'm talking about people who bought $10 million apartment complexes, who are complete idiots. $50 million real estate developments, $600 million with REITs. And they bought a $300 million property for $600 because they think it could all cash flow because they thought rates would remain low for as far as the eye could see. You know, that was the theory. That was the narrative. What happens to these people? Well, all of a sudden, then you'll have an AOC and Elizabeth Warren. And instead of investigating the Wall Street companies, they invest the REITs for taking advantage of mom and pop investor. Now, I'm not casting aspersions on anyone's motives. I'm just saying, I think it'll happen. Are we seeing the collapse now? Not really. I mean, we're seeing a slowdown in real estate prices. But if you look at the Case-Shiller 20 market home index price, it's kind of leveling off. There's a lot of data points that weren't there in 73, 74. I think if you look at a chart of where we are today compared to where we were in 73, 74, it's very similar to that. So the market in 73 had a drop, and then 74 had a drop of another, it was about 20% drop 73, 20% drop 74. A lot of people have never been through these types of things. New investors. I thought that was the most interesting part about this interview, and you always learn things from Dr. Hunt, is 38. If you think about it, history repeats itself, but if you're 38, you don't know history. You may have a distrust of the stock market, but you may just think rates will stay low forever. And maybe they won't. Maybe Larry Summers is right. Maybe we need 8 to 9%. So keep it locked here. This is the Financial Quarterback. If you have a question, type it in to the chat box. Taylor will go to you when we return. This is Josh Jalinski, the Financial Quarterback. Don't touch that dial.
Tune in to the Financial Quarterback Josh Jalinski this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Jalinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jalinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jalinski.org. That's JALINSKI.org.
Okay, one of our YouTube commenters, serial commenters, so thank you. She has 3 couples live in the same house on my block. Maybe Cheng is onto something. People cannot buy a fixer-upper because the price of supplies without labor is outrageous. Prices of tiles for 6x4 tiles after a flood last week are $400. I can attest to that. I'm familiar, I have some investments with rental property. It's costing me like 10 grand to redo this house that it's a very, it's a 2-bedroom rental. 10 grand to just revamp it. It's an incredible cost for a basic home. I mean, and we're just like fixing stuff. And the other problem is bureaucratic mandates. We literally were told by this township, you have to do 100 different things. You have to do a lead-based paint test, even though we have no lead-based paint. And I gutted the house. We still have to pay $500 for a test. Oh, you need a steel beam girder here instead of wood, even though the house has been around for 100+ years. So these local towns, particularly in New Jersey and elsewhere, driving people out with their ridiculous mandates. So a lot here. Earthquake retrofit. There we go. We don't really have earthquakes in New Jersey. So MMT. So the left is insane on MMT, but we got to be honest here. The right allowed it to happen. I mean, Biden spent 6 to 7 trillion. Trump spent 6 to 7 trillion. We got to get spending under control if we're ever to get inflation under control. Now, that's a very simplistic response, And I do believe in Jeff Snyder's thesis that we will eventually have disinflation, that money is not being dried up. It reminds me a lot of 07, 08, before that big dip in 09. But there is some good news. Price of lumber coming down. Market up 10% off of its lows. We're at that critical 4150 number on the S&P. So there is some good news. Employment is strong. Unemployment numbers very low. So there are some good signs in the economy. We just have to get this inflation number control, but we shall see. So let's go into a little history of the income tax, because the majority of you have a 401k, IRA that could be filled with stocks, Bitcoin, whatever you want to fill it with. And do you realize that your partner is Uncle Sam? And one of the things I talk about regularly, so Dr. Hunt's an expert in all things Fed. I try to be. But where I shine is on the history of the income tax as we know it. And this is the logic that AOC, who by all likes of it, Liz Warren still in the Senate. Bernie Sanders still in the Senate. AOC still in the House. And their numbers are growing. So if you look at the history of the income tax, and I will show, maybe we can get it so where I can show it on YouTube. Income tax as we know it originally started in the Civil War, and Honest Abe honored his promise. And Honest Abe said, I'm going to make the income tax temporary. He held firm to that. I don't know if it was him, but basically we had income taxes in the Civil War, and then it went down to zero. And the progressive era happened, and we somehow started to tax income. Amendment to the Constitution, all that stuff. So we are at 1913. Income tax in 1913 was 7%. This is one of the reasons I didn't like Herman Cain, God rest his soul's 999 plan. I don't want to have a national sales tax. I don't want to have another national VAT tax, because it always starts out as temporary and then it leads to a royal screw job. I want the government to live within its means on the income tax. A lot of conservative people will say, we want a sales tax. Fair tax, not going to happen. And I'm not a fan of it, because I think we should just flatten the income tax, lower it to 15, 20% max. That would be great for the economy. But the marginal income tax started at 7% to fund World War I. Then it ratcheted up to a higher rate of 67%. Now realize, I'm talking about marginal rates, not effective. So effective is what you actually pay. Marginal is the highest tax the government charges you. So when AOC and others say, you know what, taxes, and they are right, taxes from the late 40s to 60s were 91 cents on every dollar. That was only for the richest of Americans. So you had to make the equivalent of like millions today. And very few people paid the marginal. They paid effective. There were far greater write-offs. You could write off your vacation. You could write off your horses. You could write off your alpacas. Whatever you could write off pretty much through your business. So nobody really paid that. So I'm going to show the chart on YouTube. This is the marginal income tax rate chart. But first, we're going to go to the phone lines at 800-321-0710. Go ahead, Michael.
Yeah, I was wondering, how your actual savings account stack up against Bitcoin in view of this inflation, but Bitcoin seems to be a little bit scary to me.
Well, I don't think you should go into Bitcoin if you're not comfortable with it. If you want to start with one, get off zero. But the point is, people have gone to Bitcoin as a get rich quick scheme. And it's not it's a superior savings technology. And if you go to usdebtclock.org, they have a dollar to crypto ratio. I actually think it should be a dollar to Bitcoin ratio, because I think crypto, I don't believe in virtually any cryptocurrency except Bitcoin. The dollar to crypto ratio now is $20 to 1. In 2013, that was 9,661 to 1. That's even after the Bitcoin crash from November 2021 to today. And the thesis is really people are going to be fed up with the Fed. They're going to opt out of the current monetary system. And that's sort of the long-term thesis behind Bitcoin. I've never been one to say it's a get-rich-quick thing and, to the moon or all the memes. The point of stocks and Bitcoin and real estate is only buy what you can afford to lose and only buy what you can afford to hodl, which is hold on for dear life, for those of you who don't know. So the point is you don't, I'm not advising anyone to do anything with their money. If you want a review, call us 888-988-JOSH. But too many people look at things like even this usdebtclock.org, which is a site I'm going to, great website. I'll show it on YouTube now. If you go to the lower right, dollar to crypto ratio, 49 to 1. I don't know, maybe somebody knows the dollar to Bitcoin ratio in 2013 versus the present, probably very similar. So dollar to gold ratio, now 112 to 1. So Bitcoin has overtaken gold because of its transferability, portability, and it's a superior monetary technology. But, we can save that for another day. Any other questions?
No, that was it. I just, I constantly see the money in the bank being worth less, and and it looks like it's only going to get worse.
Oh yeah, exactly.
And I'm actually seriously considering, basically not to get rich or anything like that, just to hold off the stuff that's coming down the road.
Yeah, we could have. I believe in it, even if it's $8,000 a coin, even if it's 10, even if it's 3,000. I believe in the long term, story. I don't think. We've seen the end of the bear market. Maybe we will have a reprieve for the rest of 2022 and we'll hit it in 2023. Nobody knows the exact future. That's the importance of diversified asset classes, French Fama theory, having different asset classes, weighting them, having some stock-based accounts, having some, it's like the old Talmud. A third in real estate, a third in stocks, and a third in debt instruments or bonds. Never seen anybody going broke with that third principle. So we actually have a model where you can verify, okay, am I overweighted into one asset class or another? And give us a call, 888-988-JOSH. Okay. Next up, we'll go to your questions at 800-321-0710. Let's go to the usdebtclock.org. If we go back to the usdebtclock.org, 30 trillion in debt, 243,000 per taxpayer. This is where I do think Hunt and others may be misguided. I didn't ask him this. We had Dr. Kotlikoff on earlier, and he basically said the effect of the 30 trillion is 20 trillion because the government is inflating different prices. So if you think about it, your property tax is going up exponentially. Your other taxes related to sales tax going up. If the price of a sandwich is 40% more and you're in a state that has sales tax, your tax bill is 40% greater. So he said that the effect is about 20 trillion. So the government actually likes this inflation. So there's two theories. I don't know which theory is right. We shall see. One is that if interest rates go higher, the debt remains unserviceable, so that the Fed will want to keep rates lower because of the long-term trajectory. The other is that they don't mind the inflation, because if you think about it, if you have all these people with bank accounts and let's say you have $1 million in a CD earning 1%. It's $10,000 and you're in a 20% tax bracket. That means $2,000 of that 10 goes to the government. But now if that 10 is 30, government just tripled their tax revenue on the same savings account. There's not a ton of savings really in the country for I think it to work. So I probably favor the argument that the government has a vested interest in keeping interest rates low, but it's just something to think about. That inflation, the inflation story may be good for the debt, even though, I don't really believe in that, but we'll see. So let's go back to the history of the marginal tax bracket. So I'm sharing the chart here. Now you might realize, why does this matter? Because for 30 some odd years, you were deferring into your 401k when rates were 28% in the latter part of Reagan's years, 40% in the Clinton years, 35% in the George W. Bush era, 40% in the Obama era, and 37% in the Trump tax code. So if the vast majority, the U.S. is a pendulum, right? So probably what will happen, we'll have DeSantis be president in 2024 to maybe 2032, maybe 2028. Maybe he does a lousy job. Nobody knows. 2032, we may have our first socialist president in the mold of Sanders or AOC. And they will go after the 401k because that's where the money is. Typically, the country has been swinging further left and further right on the pendulums. So when you defer money in your 401k or IRA, now you'll see people on the internet say, don't do it. I'm not an advocate of not putting money in your 401k, because the answer to all of these problems is more money. So if they double tax rates and you've doubled the value of your account, that'll help. Now, there are ways to solve that. Do Roths, have brokerage accounts outside of an IRA, look at cash value insurance, look at trusts, look at real estate as a tax haven, look at creating businesses, car washes, Bitcoin mining. We have a Bitcoin ATM machine guy who listens faithfully. So starting a business is a great way to have tax write-offs, whatever it might be. But you're going to have an exit strategy for your 401k or IRA, and I'll talk about that later when we return. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the Financial Quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to the Financial Quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check.
Okay, we're back taking your question on All Matters Financial at 800-321-0710. So Cheng is saying he's thinking about starting a business line of credit. I think that's an excellent idea. I think people need to have cash liquid, and be mindful that your bank may have suspended your line, and be very careful about that. So if you have a question, type it in the chat box. Jackie says, will Sanders even be alive in 2032? Nobody knows, right? I mean, people said that about Joe Biden when he started his term. People live till 195, whatever, but that's not the issue. It's his spiritual progeny. It's his Marxist brethren. It's, like the kids with Che on their shirt, not realizing that Che was a murderous lech of a human being who killed a bunch of people so that the communists could rule. That's sort of the Bernie. Bernie will be their Che. Is Bernie AOC's Che? I don't know. And I don't want to get too political because I think people on the left and the right need to sort of moderate to some degree their stances for the good of the republic. But it's a problem. I mean, these people believe, if you go to this chart, let's go back to this chart. They believe, not either they're uninformed. Here's the thing. Someone can be ignorant or dangerous in intent. Ignorant or negligent, the result is the same. So if you look at this chart, so from 1940 to pretty much JFK, so almost 20 years, 91 cents on every dollar was taxed. But that was marginal, not effective. But these people are so intellectually honest, they don't say that. So they said, you know what, in the 50s, everybody loves the 50s, Ozzie and Harriet, the two-car garage, only one parent needed to work to make ends meet. Everybody says, oh, let's harken back to the 50s. Some people say that, not everybody. Certainly not from racial tensions, things like that, segregation, all that. But my point is, they say that. They go, AOC says, well, in the 50s, we had economic equality, we had less income inequality, and we had marginal tax rates as high as 90%. So therefore, correlation doesn't equal causation. They violate every rule of logic. That's the thing. If your kids are young, mandate that they take logic. Take a logic course in college. Take a logic course. We homeschool our kids. We make them all take logic. Something I wish I took a logic course, to be honest. That my eighth grader going into ninth grade smarter than me. Why? Because she took formal logic for like 2-3 years. She can break down any argument. It's a fascinating thing to go through. She says, oh, Daddy, you're off here. And I'm like, okay, well, you can't win an argument. Now I can't win an argument with my wife. I can't win an argument with my daughter. And my other daughter's going into logic as well. So here's the thing. They assume that because one set of conditions held true in the 50s, that just, correlation equals, okay, well, the rates were 90% here. That's a fallacy. So there were a lot of other factors that contributed to income inequality. Probably the biggest was untethering our money from the gold standard in the early 70s. So money didn't mean anything anymore. But that's neither here nor there. None of these people want to advocate for a Bitcoin standard or a gold standard or something where the Fed just can't, do whatever they want to do, and the federal government can't print themselves out of things. So that being said, they're using this talking point, 90% rates will spur on a utopia, but now realizing that's marginal rates, not effective. Now, if you have a 401, an IRA, a 403B, what I call the alphabet soup of investing, 457, TSP if you work for the government, you are essentially in business with Uncle Sam for as long as you live and as long as your kids live for 10 years, because there's something called the stretch IRA. So let's say you were a good little boy or girl in school, you grew your IRA to 2 million smackaroos. And we have a 40% tax rate. That means the government has an $800,000 lien on that 2 million, with state and federal taxes currently at around 40%. Now, if you're in Florida, it's 37 cents on every dollar. but you don't own 37% of that IRA. If you think you do, take money out, you'll realize you don't. They'll throw you in jail if you don't pay that. So here's the thing. Are you prepared for the coming tax-mageddon? Because when you die even, your heirs have 10 years to pay all that. So you say, well, I'll just take my RMD. Well, that might be great, but you're just increasing the largesse of the federal government. So you should be doing something that I call a strategic rollout, which is sure, take advantage of every write-off they give you. I do. Max out your 401k. But if you can afford to pay the tax now, consider maxing out a Roth 401k for your business. You might say, well, Josh, I make too much money. Well, there is no income limitation on a Roth 401k. There is a limitation on the Roth IRA. There's no limitation on cash value insurance. There's no limitation on a brokerage account. So one way to help yourself against the rising brunt of taxation is do what Buffett does. Buy stocks that do not pay a dividend. Why? Because that dividend goes on your tax return each year and you have compound taxation. So we have a question from the audience. When making an account transfer on death, which generation should get larger percentages? Children or grandchildren? Both couples make high bracket income, want to save tax. Well, I recommend you call my office for a free review. If anybody's listening, give a free review to those of you who call us at 888-988-JOSH. But this is a good question because I'm seeing a lot of greedy children, meaning, yes, your kids are greedier than your grandchildren. So if you have an estate of $2 million and you have 4 kids and leave each kid $500,000 each, you really think that's going to be around for your grandkids? Jim, if I gave you $500,000, what would you do with that money?
Spend it.
You'd maybe pay off your house, pay off your debt. But Jim's a responsible guy. He works for the financial quarterback, but he's still going to spend it. I tell parents this all the time. If you want that money to go to your grandchildren, create a trust. Now, I'm not an attorney. I'm not giving legal advice. But set it so if Jim was your son, he would get a paycheck every month to make life a little easier. But then his kids would also get that. So you would have generational wealth. Because if you leave things outright via primary beneficiary, your kids are going to spend it. Your grandkids, they'll never even get it. But I love Johnny. I want to pay for Johnny's college. Well, you better do that now. Because, well, I'm not even an advocate of going into debt for the college. Really, I think colleges have become the middle class cartel. If you took the money you were paying for college and you bought a piece of rental real estate or you invested that long-term in the market, you'd have way much more money. We're going to have to do a show on that where I verify those numbers. And if you're going to go to college, go to community college. Go to where you get a free ride. Don't go to, socialist training grounds. So there's a lot here. So when you have a Roth solo 401k, there was a question from Taylor in the audience. Do I do a Roth solo 401k or do I do a SEP? A solo 401k is a very powerful way. If you're a small business and you normally make too much money to do a Roth, you can put money in a solo Roth, powerful benefit, and we can help you do that at a very low cost. Mark says, what's the difference between a Roth IRA and a Roth 401k? Roth IRA, the max you can put in is about $7,000, whereas a Roth 401k, you can put in about $27,000 depending on your age. And somebody says, I make a high salary and have been looking to buy stocks rather than put the money in a 403b. Any thoughts? Consider a Roth 403b. If you don't know that, if your place of employment doesn't have that, call me, the financial quarterback, at 888-988-JOSH. Would love to help you with that. Roth solo 401ks are very cheap to administer. A lot of you also have pensions and you don't like the fee of your pension administrator. We've teamed up, unaffiliated but we know some good pension providers that could provide it at a reasonable cost. So call us 888-988-JOSH. And here's the thing, the stretch IRA has died. Are you prepared? 888-988-JOSH.
The preceding program was sponsored by the Jalinski Advisory Group. Any awards, rankings, or recognition by unaffiliated third parties or publications, including five-star wealth manager, advisory of the year finalist by senior market advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at Jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations.
So this disclaimer
All information
needs to be on
presented
there,
is believed to be factual and up to date. Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Investment advisory services offered through Wealth Quarterback LLC.
WOR and WAXQ HD2 New York, an iHeart radio station. Available everywhere on our free iHeartRadio app. #1 for music, radio, and podcasts.
There's no... Thank you all, Clubhouse. And again, for those of you who want, call me 888-988.